Hello learners, in today's lecture we are going to discuss the secondary market. The learning objectives of today's lecture are: firstly we will discuss how secondary market operates, then we will see the advantages of secondary market. After that we will cover various tools of secondary market, and then at last we are going to see the negative aspects of secondary market. In the last lecture, we have discussed regarding the meaning of secondary market, various intermediaries of secondary market, various functions of secondary market, and the types of secondary market. So now let's see, in today's lecture we are going to cover the various we are going to see how the secondary market functions. So let's start with this. So, the following are the crucial elements of the secondary market to comprehend its operation. So, the first one, that is platforms for trading. Over the counter, OTC market and stock exchange are the venues for secondary market transactions. The New Year Stock Exchange and the Bombay Stock Exchange are two well-known stock exchanges. Through these platforms, the exchange links buyers and sellers. Investors place their buy and sell orders. The second, that is market participants. Trades in the secondary market are made possible by a few important players. The first one, that is investors. People who purchase or sell securities on the market, whether they are individuals or institutions. Then brokers, by bringing together buyers and sellers and carrying out orders on their behalf, these experts or businesses help the trading process. Then market makers. These are the organizations that keep the market active and liquid by standing ready to purchase or sell securities at any movement. Then after that comes the that is making purchases. In the secondary market, investors usually place two kind of orders. The first one, that is market orders, and the second one is limit orders. Firstly, let's see what is market orders. These provides the broker instructions to purchase or sell a security at the best price on the market. Although this kind of order guarantees prompt execution, the best price might not be available. Then the second one, that is limit orders. An investor can indicate the price at which they are willing to purchase or sell by placing a limit order. They have more control over the transactions this way. But if the price is not met, they could have to wait longer. After this, after making purchase, the next come, that is calculating prices. In the secondary market, supply and demand determine prices. A security's price will increase if there are more buyers than sellers. On the other hand, the price will typically decrease if there are more vendors than customers. Fresh orders are placed based on the general mood of the market and the state of the economy. The price is always changing. After calculating prices, the next come, that is carrying out trades. A deal is completed on the trading platform when the orders of buyers and sellers match. When it comes to stocks, sellers get paid and buyers obtain ownership of the shares. This trade specifics are forwarded for resolution. After carrying out trades, the next come, that is settlement and clearing. The act of confirming the trade and transferring ownership between the buyer and the seller is known as clearing. The actual exchange of money and securities is called settlement. When it comes to equities, the transaction is finalized following the settlement, which usually takes place within 2 business days. After that, after settlement and clearing, the next that is constant trading. All day long, the secondary market is open for business. Real-time buying and selling of securities occur and prices are constantly adjusted to reflect shifting supply and demand. This allows investors the freedom to modify their holdings in response to current market developments. Then the next come that is market data. Real-time tracking of shares price, trading volume and other important information is available to investors. Investors can use this information which is accessible through trading platforms or financial news sources to help them decide whether to buy or sell securities. After this, the next is control and monitoring. Strict regulations are placed to guarantee equity and stop fraud in the secondary market. The Securities and Exchange Board of India, SEBI, is in charge of the Indian market. These regulatory agencies uphold laws that safeguard investors and encourages openness, which contributes to the preservation of the market trust. Now, after seeing how the secondary market operates, now let's see some of the benefits of secondary market. These financial systems as a whole, issuers and investors all benefit greatly from the secondary market. A few of these are listed below. The first one that is price discovery. By convincing investors to purchase assets based on the various market dynamics, supply and demand, the secondary market guarantees price discovery. This makes it possible to guarantee that financial instruments are priced effectively, aids in a fair firm valuation and ensures that investors get a fair return on their investment. Now the second benefit of secondary market, that is it transfers risk. By purchasing and disposing of assets, investors can modify their risk in the secondary market. For example, if an investor have a stake in a business and is able to predict a possible market decline, he or she may sell the stake to another investor, shifting the risk of the share to the new owner. The great degree of flexibility in the secondary market allows investors to make necessary adjustments to their portfolios. The third advantage of secondary market, that is transparency. Since investors have easy access to information regarding the issued securities, the issuer and the trading volume, that is lot size, secondary market activities are often transparent. Because of this, investors are better equipped to make informed investment selections. The next benefit of secondary market is capital raising. By enabling business to issue new securities to raise money for their operations, the secondary market makes capital raising easier. Secondary offerings or follow-on public offerings can be used for this. The next advantage, that is liquidity. Funds can move more easily, which affects investment liquidity. Securities that have already been issued are easily purchased or sold by investors. The secondary market facilitates trading for investors by enabling them to swiftly access funds when needed and to modify their. Now let's see the various tools in the secondary market. Three categories can be used to group aftermarket trades on various instruments. The first one, that is fixed income instrument. These are investments that produce regular or predictable income. For example, the principal amount at maturity and the monthly interest. Bonds and debentures are example of fixed income securities. The second is variable income instrument. This type of income is not fixed as the name implies. The market determines the variable returns on these investments. A stable income is not guaranteed. Despite their significant risk, these products have the potential to yield substantial rewards. Derivatives and equities investment are two examples. The third one is hybrid instrument. Hybrid instruments are those that offer both variable and fixed return. An investor may receive high or low return on their investment in these types of instruments, but a certain amount will always be generated. Convertible debentures, which are essentially debt securities with the potential to be covered into equity shares over time, are an example of hybrid product. The third one, that is counterplay risk. In the over-the-counter OTC market, investors are primarily subject to counterparty risk. When the other party in a deal fails to meet their responsibilities, there is a risk of a counterparty. There is no clearinghouse or centralized exchange party to ensure trades in the secondary market, known as the OTC, over-the-counter market. As a result, the OTC market is where this kind of risk mostly arises. Now the next limitation of secondary market, that is limited access. Investors may occasionally have limited access in certain marketplaces. For instance, only institutional or accredited investors will be permitted to make investments. These markets will not be accessible to individual investors. The next one, that is price discrepancies. A stock or bond's price in the secondary market may not be a true reflection of its underlying value or opportunities. Price disparities and misalignments between market pricing and underlying financials may result from this. So the learning outcomes of this lecture are, in this lecture we have discussed regarding the functioning of secondary market, the various benefits of secondary market and various tools of secondary market, and at last we have covered the negative aspects of secondary market. So that's all for this lecture. Thank you.